able to tell that this guy has $180 million. This guy made $34 million, he claims, basically in one wild night.
This is Kotegawa. He turned 13K into 153 million in just 8 years. He was one of the famous intraday traders in the early 2000s. His strategy is incredibly genius. After researching for a couple of days, I think I've finally figured it out. It's a little bit complex actually, but I will make it simple so you can understand. In this video, you will learn how he finds the stocks to enter, what indicators he uses, what strategy he employs, what style of trading he adopts. Additionally, I will provide you with a step-by-step example to explain his strategy and the filtering conditions he uses to find the perfect stock. Let's get started. First, we need to understand his specific trading conditions. He likes to identify the bottom of a downtrend and profit from the reversal. For example, we can observe a prolonged downtrend in the chart, and Kotegawa is trying to predict the bottom of the downtrend in order to profit from the bounce. It's super hard, you know, but if predicted correctly, the profit will be extremely large. Luckily for us, he has his secret strategy, which can significantly increase the chances of success. He says there will be more opportunities to execute this strategy in a bear market, but a bull market is also fine. However, there are some points that need attention, which I will talk about later. He usually holds his positions for 1 to 2 weeks, and in a bear market, he only looks for stocks whose prices are 20% below the 20-day moving average, and 35% or more would be even safer. But there is a problem. Not all stocks react the same way. The sensitivity of a stock's rebound level depends on factors such as market sentiment and the stock sector. For example, if the current market sentiment is very bearish, stocks usually have a lower chance of bouncing. If the current market sentiment is very bullish, stocks usually have a higher chance of bouncing. Also, the technology and biotech stock sectors are usually more volatile than the utilities sector, so the tech sector usually has a bigger gap than the utilities sector. So basically, this strategy has 2 major key points. One is finding the right moving average threshold, and the other is identifying the correct bouncing points. You will learn about these aspects in the later video. First, let's talk about how to find these stocks. In the first step, open the TradingView stock screener. Change the time frame to 4 hours. Change the symbol type to common stock. Toggle the following exchanges. Set the change percentage to below -10%. Set the current price to above $1. Enable the current trading day. And set it below the EMA 20 by 20%. In the second step, we need to find stocks that are gradually downtrending, not experiencing sharp movements. For example, a chart like this is good, a chart like this is bad. Now we should have a list of the well-selected stocks. It's time to add indicators to the chart and execute the strategy. First, add EMA to the chart. Change the length to 25. Next, add RSI to the chart and keep the default settings. Finally, add MACD to the chart and keep the default settings. This strategy is designed for longer time frames, such as 4 hours and 1 day. Here we will use the 1 day's time frame as an example. First, we need to find a gap larger than 20%. A 35% gap would be even better. However, as mentioned before, this also depends on market sentiment and the stock sector. For example, if we look at the SuperTrade trend table and it shows that the market sentiment is bearish, we should choose a larger gap to enter the trade. Conversely, if the market sentiment is bullish, we should opt for a smaller gap to enter the trade. If you're interested in the SuperTrade indicator, I will provide a link below. Now, we come to the most important part of the strategy. We need to plot the resistance and support levels on a larger time frame. After we finish, we wait for the price to hit the support and bounce back. It's important to note that in a bear market, we should only aim for major support levels. And in a bull market, we can aim for minor support levels. as they also have a high chance of bouncing. Next, we need to check if the RSI is oversold when the price hits the support. Next, go to the 15-minute time frame and wait for the price to bounce back, and also ensure that the MACD turns green. Then, we enter the trade. It's important to note that the take profit points are dynamic. If we're in a bull market or a more volatile sector, we can aim for a larger take profit point. If we're in a bear market or a less volatile sector, we should aim for a smaller take profit point. This strategy is great, isn't it? Here's another video I've made before, discusses the strategy he used to turn 10K into 1.1 million in 12 months. What indicators does he use? And what strategy does he employ? Check the video to learn more.